These are the 6 critical tax traps that every precious metals holder faces in 2026, and the penalties for getting them wrong could devastate your wealth. The IRS has quietly transformed how it tracks precious metals transactions. And what many investors don't realize is that their gold and silver holdings are now squarely in the government's crosshairs. With gold reaching historic highs of over $5,500 per ounce in January 2026, and silver jumping 144% in 2025 alone, the tax implications of these gains have become massive. The first trap is the most expensive one: the collectibles tax rate. While most investors expect their long-term capital gains to be taxed at 15 or 20%, physical gold and silver get classified by the IRS as collectibles, and subject to a maximum tax rate of 28%. This means that if you bought gold at $2,000 per ounce and sold it at today's prices above $5,000, you're looking at a gain of over $3,000 per ounce taxed at 28% instead of the lower capital gains rates. Let's put this in perspective. If you owned 10 ounces of gold bought at $2,000 and sold them at $5,000, your gain would be $30,000. At the standard long-term capital gains rate of 15%, you'd owe $4,500 in taxes. But under the collectibles rate, you owe $8,400. That's an extra $3,900 going straight to the government because of this classification. And if you're a high-income earner subject to the 3.8% net investment income tax, your effective rate climbs even higher. The second trap involves the cash reporting requirement that most precious metals buyers have never heard of. Form 8300 must be filed by dealers for any cash transaction exceeding $10,000. But here's where it gets tricky. Cash doesn't just mean currency. It includes cashier's checks, money orders, traveler's checks, and bank drafts with a face value of $10,000 or less. Personal checks, wire transfers, and credit cards don't count as cash, regardless of the amount. The 24-hour aggregation rule makes this even more complex. If you make 2 separate purchases of $6,000 each within a 24-hour period, the dealer must treat this as a single $12,000 transaction and file Form 8300. The form must be submitted within 15 days of the transaction, and the dealer must provide you with a written statement by January 31st of the following year. What makes this particularly dangerous is the structuring provision. If you deliberately break up a large purchase into smaller amounts to avoid the $10,000 reporting threshold, you've committed a federal crime under Title 31, Section 5324. The penalty is up to 5 years in prison, and the government doesn't need to prove the money came from illegal activities. The intent to avoid reporting alone makes it criminal. The third trap centers on dealer reporting requirements through Form 1099B. This is where the precious metals industry has created widespread confusion through misleading marketing. Dealers are required to issue Form 1099B for specific types and quantities of precious metals transactions. For gold bars and rounds, each item must have a purity of at least 99.5%, with a total quantity of 1 kilogram or more. For silver, the items must have a purity of at least 99.9%, with a minimum sales quantity of 1,000 troy ounces. Specific coins have their own thresholds. Sales of 25 or more 1-ounce gold maple leafs, Krugerrands, or Mexican onzas in a single transaction trigger Form 1099B reporting. For 90% silver US coins, any sale exceeding $1,000 in face value must be reported. But here's the critical point that many dealers conveniently omit. Whether or not a Form 1099B is issued has absolutely no bearing on your tax obligations. You are required to report all capital gains from precious metals sales, regardless of whether you receive a tax form. The IRS has made this crystal clear, yet many investors operate under the dangerous assumption that no form equals no taxes owed. The fourth trap is the American Eagle exemption. which creates both an opportunity and a potential pitfall. American Gold Eagles and American Silver Eagles are exempt from Form 1099B reporting requirements regardless of quantity. This exemption exists because these coins are legal tender, giving them a unique status under IRS regulations. Many dealers market this as non-reportable gold, but this terminology is misleading and dangerous. The exemption only applies to dealer reporting, is not to your personal tax obligations. If you buy American Eagles at $2,000 per ounce and sell them at $5,000 per ounce, you still owe capital gains tax on that $3,000 per ounce profit. The dealer doesn't report the transaction to the IRS, but you're still legally required to report your gains on your tax return. Some investors have fallen for the myth that American Silver Eagles are somehow exempt from capital gains tax entirely. This is categorically false. While certain websites reference obscure laws suggesting tax exemptions, the IRS has never recognized such exemptions in practice. Every precious metals transaction that results in a gain must be reported and taxed according to current tax law. The fifth trap involves the wash sale rule exemption that actually works in your favor, but only if you understand how to use it properly. Unlike stocks and securities, precious metals are not subject to the wash sale rule under IRC Section 1091. This means you can sell precious metals at a loss to claim a tax deduction, then immediately repurchase the same or similar metals without losing the deduction. For example, if you bought silver at $30 per ounce and it's now trading at $25, you can sell to realize a $5 per ounce loss for tax purposes, then immediately buy back the same amount of silver. This strategy can help offset gains from other investments or provide up to $3,000 in deductions against ordinary income, with additional losses carried forward to future years. The sixth and final trap is the self-reporting obligation that catches many investors completely off guard. The IRS expects you to track and report all precious metals transactions based on what actually happened, not just what shows up on tax forms. This means maintaining detailed records of purchase dates, amounts, prices, and sale information for every transaction. With audit rates for high-income individuals expected to rise from 11% in 2019 to 16.5% by 2026, the IRS is significantly increasing its scrutiny of unreported income. The agency has implemented AI-driven audit selection processes and is specifically targeting more than 125,000 high-income individuals who failed to file returns, including over 25,000 with incomes exceeding $1 million. The consequences of getting these requirements wrong are severe. Penalties for failing to file required information returns start at $60 per return for those filed within 30 days of the due date, escalating to $330 per return for those filed after August 1st, or not filed at all. For intentional disregard of filing requirements, penalties jump to $660 per return. Form 8300 violations carry even steeper penalties. $310 per return for negligent failure to file, but for intentional disregard, the penalty becomes the greater of $31,520, or the amount of cash received in the transaction, capped at $126,000 per transaction. Now, let's address the current political landscape and how it affects precious metals holders. Despite widespread concerns about new regulations, the Trump administration has actually provided significant benefits to the precious metals market. Gold, silver, platinum, and palladium were exempted from the 10% baseline tariff on imports that took effect April 5, 2025. Trump announced on Truth Social that gold will not be tariffed, providing clarity after initial confusion when Swiss gold bars were temporarily subject to tariffs. This exemption reflects the unique status of precious metals as monetary assets, critical to financial markets and central bank reserves. The policy has helped stabilize precious metals supply chains despite broader trade disruptions affecting other commodities. The dramatic price appreciation in precious metals during 2025 has created unprecedented tax situations for many holders. Gold rose from $2,600 per ounce to over $4,300 by year-end, setting 53 new all-time highs during the year. Silver's 144% appreciation was even more dramatic, creating massive taxable gains for investors who sold positions. J.P. Morgan Global Research is forecasting gold prices to average $50.55 per ounce by the final quarter of 2026, rising toward $5,400 per ounce by the end of 2027. These projections suggest that the tax implications for precious metals holders will only become more significant in the coming years. For those looking to minimize their tax burden legally, several strategies remain available. The most fundamental is the holding period strategy. Maintaining ownership for more than 1 year reduces your maximum tax rate from ordinary income rates as high as 37% down to the 28% collectibles rate. Precious metals IR as offer another avenue for tax-deferred growth. Gold and silver held inside a self-directed IRA aren't taxed when bought or sold within the account, allowing for tax-free portfolio rebalancing and compound growth until withdrawal. Tax loss harvesting using the wash sale exemption can help offset gains from other investments. And for investors with substantial gains, opportunity zone deferrals can postpone tax obligations for up to 5 years while potentially reducing the ultimate tax burden. The key to navigating these complex regulations is understanding that the precious metals market operates under a unique set of rules that differ significantly from traditional securities. The combination of collectibles tax rates, specific reporting thresholds, and cash transaction requirements creates a regulatory environment that rewards knowledge and punishes ignorance. As we move deeper into 2026, with gold prices reaching historic levels and IRS enforcement capabilities expanding through artificial intelligence and increased funding, the stakes for precious metals holders have never been higher. The 6 traps we've outlined represent the most common ways investors find themselves in serious trouble with the tax authorities. The irony is that while precious metals are often purchased as a hedge against economic uncertainty and government overreach, improper handling of the tax obligations can result in government penalties that dwarf any potential benefits from the investment itself. Knowledge of these regulations isn't just important for compliance. It's essential for protecting the wealth you've worked so hard to accumulate. The precious metals market will continue to evolve, and tax regulations will undoubtedly become more complex as the government seeks to capture revenue from this growing asset class. But for those who understand the rules and plan accordingly, physical gold and silver remain powerful tools for wealth preservation and portfolio diversification in an increasingly uncertain economic environment.